I've traded through the dot-com bubble, the financial crisis, and now the current AI-driven market surge, and the parallels are striking. History may not repeat exactly, but it often rhymes. These kinds of bubbles can be volatile, yet they also create some of the most extraordinary trading opportunities you'll ever see. Let's break it down with Nick. Nick, each week I look forward to doing another session with you, and you came up with a great idea to talk about the AI bubble and some of the opportunities that may come from that. And I would just like my eyes lit up thinking about this because some of your ideas were pretty cool. And so I want to dive into this. Let's talk about it. First off, let's talk about, because you were talking about a pair trade idea, playing this Nvidia story versus AMD. And well, listen, I'll let you explain it. Let's dive into it. What are you thinking?
So the whole idea with that would be that essentially, if you're bearish on AI and you think that we're in a bubble, Nvidia is probably the biggest part of that bubble right now, perhaps, because
Right.
the revenues have ramped up heavily, but that's based on data center spending. And if you understand that their customers are predominantly Meta, Google, and Amazon, among others. Those are their biggest customers right now. That they're very heavily concentrated amongst a few customers.
Yeah.
Once that spending slows down, their revenues could drop off a cliff very fast. I'm not saying that they're going to go to zero, obviously, but they could get cut perhaps by 30, 40%. And right now, the market's paying for growth. So the idea here would be that if you do believe that, what you could do is ask the question: do you believe that Nvidia or AMD have a higher probability of doubling in price right now based on the current market cap of the company? So Nvidia right now is worth 4.4 trillion roughly.
So let me pull up
Then
the chart here. So here we can
yeah,
see the stock's at 182 and a $4 trillion market cap. So
yeah,
like a doubling of this thing, let's say going to $360, like up here,
yeah,
you're basically talking about the stock being an $8 trillion company. Like, and you so go on.
yeah, yeah. So the idea would be that, do you believe that Nvidia could go to $8 trillion before AMD goes to, for example, $500 billion? And I firmly believe that AMD is going to dominate the inference space of AI. Now, like when you discuss AI, you understand that there's training and there's inference. NVIDIA GPUs are heavily used for training
Mhm.
AI models. Now, once you train a model, kind of like going to school for 4 years and getting a degree, that's a lot of time, a lot of money spent, and energy spent on that degree. Now, the information is actually in your head now, and that's where you get inference, right? How do I apply that information and knowledge to real world problems? This is where AMD is going to dominate, in my opinion. Again, so I think AMD will double before NVIDIA doubles. And as a result, I think a nice trade for next summer, going out, longer term view of June 2026, would be to go long in the 200 strike call options and short the 300 strike call options. So $100 wide call
Full
spread,
caution. Yeah.
which right now costs you about $16 debit for a maximum profit of $84, which is
Okay, so
pretty.
just to clarify for all of the listeners, we're going out to June of next year, so 310 days, correct, Nick?
Mm-hmm.
Right. So,
That's right. Yeah.
so here I have the chain. The $200 call is 21.30. The $300 call against it is $5.40. So you're talking a $16 outlay for $100 widespread.
Exactly, yeah. And then if you want to take it one step further, let's say you want to own AMD right now at the current price, like 173, 174 roughly. Instead of doing that, you could sell a cash secured put for that same expiration date, June 2026. And right now you're getting about $14 roughly. So the idea here would be to pair both those strategies concurrently, the bull call spread from 200 to 300, and then combine that with the cash secured put at 150, gives you a net debit cost of that overall strategy of about $1.50. So you're risking basically $1.50 for a maximum profit of 98.50 on the upside on AMD for next summer. And right now we're seeing
Or the risk
AMD.
of owning the stock, though.
Yes, or the risk of owning AMD at 150 a share, which is about roughly 15% lower than the current price,
Right.
approximately. The idea is that basically below 150, you own the stock at 150. Between 150 and 200, all you lose is 150, $1.50 by next summer. When I say $1.50, I mean times 100 notional shares per contract, which means that $150 overall
Yeah.
loss. And then anything above 200 is basically gravy. So let's say it goes to, for example, 240 by next summer, right? You're making $40 profit on 150 overall,
Right.
and that's a very very asymmetric bet. The nice thing is too is that if it were to run heavily before the expiration date, you can augment the strategy a little bit. I won't get into that now. If and when it happens, we can discuss that at a later episode perhaps.
Yeah.
But again, the asymmetry of risk here is pretty incredible because
It
you kind of
is.
do a scenario analysis and say, okay, below 150, I own the stock. Between 150 and 200, nothing happens, and anything over $200 is pure gravy overall.
Okay, so now you were thinking now, okay, well, imagine we have a scenario where at the same time as you have the strategy open and you even have this $150 risk of ownership on this AMD, your idea there was to potentially pair this with Nvidia. Like, what are your thoughts there?
So conventionally speaking, what would happen, having previously managed a hedge fund, you know, one of the main strategies is called a pair trade, where in essence you find two heavily correlated assets, like for example AMD, Nvidia. It used to be Pepsi and Coke, or like Walmart and Target, for example. Anything that has a similar business model and is usually
Yeah.
paired in certain ETFs will have very very similar performance overall. So what you do is you analyze the correlation between these two assets. You want to find not a perfect correlation, but kind of an imperfect correlation, roughly in statistics. Sorry, in statistics, it's something called a coefficient of correlation, which is between pretty much -1 and 1. 0 means no correlation at all. -1 means totally opposite correlation, and 1 means a full correlation where like
Yes.
each thing moves in tandem with one another, essentially. So you want to find two assets that roughly move around at a zero point 0.7 to 0.8 correlation, because whenever a deviation occurs heavily, like for example, NVIDIA runs heavy, much more than AMD, for example, or vice versa. When that happens, you would short the higher performing asset and go long the lower performing asset. And they should converge at some point in time, at which point you profit off both the short position and the long position, or one of them, which would then offset the loss of the opposing one, right? So
Right.
with that in mind, you could go short Nvidia outright and then long AMD. They're almost the same price stock wise, which is kind of nice. So you'd short AMD at, for example, 100 shares at 182. Nvidia at 182, and go long AMD at 174, for example, right?
Right.
And let's say that come December, AMD's at 220 and Nvidia's at 200. Well, what happened there, right? You made basically $50 per share on AMD, and then you lost about $20 per share on Nvidia. So overall net, you're up about $30 overall on
So
the strategy.
So just to review for all of our listeners, the idea here is very simple: that if the risk that the AI bubble could mean revert, or that it's gone too far, and we're going to end up having some, secular kind of cycle of AI spending or capex spending come off, and these stocks begin to correct, the fact is that if it keeps going, AMD will outperform Nvidia on the upside,
Mhm.
and if it goes down, Nvidia will probably go down, probably very similarly to AMD, and therefore you've hedged out that risk to some degree or another by being relatively flat net of the
Yeah.
trade. Is that a best way to describe it?
Yeah, it is. Yeah, yeah. And
Perfect.
and the nice thing is that like when you short a stock, the capital's in your account right away, because it's going to show minus X
Yeah.
number of shares in your account, and then that capital is used then to go long, AMD, for example, in this case. So basically, like, you're not actually using your own cash; you're using the short cash from the Nvidia short, for example, right? Like in this case, obviously. But keep in
Right.
mind that obviously if AMD has a hiccup and goes down heavily, obviously, and vice versa, Nvidia performs incredibly well, it can obviously blow up in your face. But
Yeah.
uh, this is why using statistics to trade is very, very important. And if you analyze the stats between both these names over a longer time horizon,
Yeah.
you might find something kind of interesting overall.
Okay. So listen, I want to move on here because another part of our conversation, you sparked my interest quite a bit, and that was on this AI story associated with Duolingo. And so Duolingo basically jumped substantially on its earnings. The stock went from 340 bucks, let's say, close to 450 bucks on a great earnings beat, and then it got derailed. I'll let you tell the story here, but I think that there's a really interesting storyline to play here.
Yeah, so I love analyzing the past and kind of taking lessons I've learned previously to apply to current situations. And a few stick out. One of them was a stock named GTAT from a while ago, which was making silicon glass for Apple. And during an Apple launch event, they announced no silicon glass would be used in their watches, and consequently, the stock price for GTAT went to pretty much zero overnight. Now, when GPT came out, ChatGPT came out for OpenAI back in November of 2022. What happened was that once they released the image generating model DALL-E 2, along with Midjourney, which was a separate image generation model, a stock called Shutterstock, which is a business that sells pretty much stock imaging to websites and businesses essentially, their stock price got absolutely decimated. Like here's the chart right here, right? So they went from what
Yeah.
130 a share to another like 25 bucks a share, something like that.
Yeah, they went
Um,
down to 14 bucks at their low. Basically, it was
yeah,
a 90% wipeout of the
yeah.
stock value off the highs.
Because you got to consider like what is a business and how do they make money, right? If everyone else can access that, their service or good for free, essentially, their business value is no longer there anymore. So they might have
Yeah.
been doing great in the past, but no longer in the future. I mean, no longer in the present or future, perhaps. Now, Duolingo, they offer this language learning platform on your phone. It's kind of it's a gamified version of language learning, kind of like Rosetta Stone from the past, but gamified, where you have like streaks and whatnot.
Yes.
Now the problem is that the valuation is kind of absurd right now as it stands, and they are heavily uh, leaning on their current brand, perhaps because they have zero moat. And what happened last week when OpenAI had their keynote for ChatGPT 5 was they had a demo where they said, "Hey, create an app for me to teach my wife French and have it cue cards and have it do pronunciation and whatever." And in a few seconds, ChatGPT built a website that had the exact same functionality as Duolingo, basically, right? Perhaps even better. Again, minus the gamified aspect of it. Actually, they did have a gamified aspect of it,
Yeah.
like showing XP or something like that, whatever. But the whole idea is that why would you want to own a stock like this, which has no moat and could easily be replaced by any number of companies that could pop up overnight that offer free language learning services? Or if you want to learn a language, just go and talk to ChatGPT, for example, right? So I don't believe that Duolingo will be around for a long time. It will probably go the way of Shutterstock or like a Peloton, for example, and get beat up very, very heavily in the longer term, right? And this is kind of one of those AI bubble plays where it's not really, you know, their CEO said a few months ago that, oh, we're a full AI company. We're going to focus entirely on AI and reduce our headcount and whatnot. But the flip side of that is that, well, if your product can be made by one person, perhaps, or a few people in house, where you're just augmenting your current application, why can't I just create an application myself and pop it up on the app store for
Yeah.
free, essentially, and you're done. That's it, right?
So Nick, I love the idea. The reality is the stock doesn't have a moat, and it is one that is highly vulnerable to AI continuing to advance with new technologies and the ability of people doing this. And so, whether you think back to 2020 and the way stocks like Peloton and Zoom, lost 90+% of their value, or just the way, like you were just showing here, how Shutterstock lost 90% of its value. This is a stock now has a very high or even beyond meat and all these others like there's so many of these stocks that have these huge runs and a mean reversion. So if you go and look at a weekly, this is a stock that at its lows traded at 67 bucks. And now I'm not necessarily saying it has to break to lower lows, but is this a stock that AI can change its model and go back down there? This is a stock that is, in my mind, an opportunity for a short. The question I have for you is this: how would you play this with options? Would you just short the stock and use call hedges, or would you put on with a spread trade, considering it has wider spreads? Like, what would be your way of approaching this with options trading?
So the problem with Duolingo is that the current liquidity in the option chain isn't very great. So the slippage is much higher because you have wider bid-ask spreads
Yes.
on the option chain, right? So what I would do is go short the stock and just buy a call option and say, you know what, for example, if you spend 30 bucks on a call, like 3 grand, you say, you know what, that's my cost of the trade essentially. Your break even is like 30 bucks below the current price. But let it
Would
just
now would you hedge for a very short window of time, like 1 to 2 months, or would you hedge it out for the rest of the year and just walk away and see what happens?
I would go out a few months and walk away and see what happens. Because again, this thesis will play out over a few quarters as they report earnings, but
Right.
more so as the market realizes that they have no moat and it's just kind of like an app. Like if you remember that company that
Yeah.
had a Candy Crush, for example, right? Their stock price was high for a bit. Same with the what are they called? Zynga, the gaming company that made the farming app for Facebook, whatever. Their
Right.
stock prices were very high for a while, along with Groupon as well. And once people realize like there's no moat here at all whatsoever, they're doing well right now. There's no exciting story behind this name. Like it's going to go down pretty much 90%, perhaps, right? So
Yeah.
I have high conviction that Duolingo will be, 100
Well,
bucks
listen,
or
here's
lower.
a stock that went from 480 bucks. Oh, sorry, went from 325 bucks up to 480 bucks, and from 480 back to 325, and did that all within
In a
like
week.
2 weeks. So spending $30 on a call hedge to be short is to me giving away the hedge for free. Like that's to me money that's well spent for the type of volatility that this stock is actually capable of going. If you are short the stock, this stock could really hurt you. And the hedge is not that expensive relative to the damage that could be done if you're on the wrong side of this trade. And so accepting a 10% risk on a short position is a very acceptable way for something that literally can lose 80% of its value from here if things really start to fall apart. Love the idea, Nick. Now, Nick, before I let you go, listen, what I love about me and you is that we both love options a lot, but we approach it very differently. I always trade the macro. I love trading the bigger stuff. I'm always concentrating on income writing and all sorts of stuff. But you love to be in the action. You roll up your sleeves and you're a gunslinger on a lot of these things, but you make great risk reward trades. So if anyone ever wants to work with you directly, how do they find you?
I have a website called optionfinity.com. It should be linked below here as well, but I have a form there you can fill out if you want to contact me via email, essentially. And I do respond to all my messages as well. So if anyone wants to work with me one on one, perhaps, or as part of one of my group sessions, definitely hit me up.
Awesome.